Good morning, everyone. Thanks for joining. I think this week we have quite a number of questions, so let's get into that. All right, let's get into the questions. Okay, the first two is not questions, it's more like comment. Let me read it out. Is it better to put this up earlier? Example, can put on Monday, but if Sunday you are not available, never mind. Delay 1 to 3 weeks, also never mind, because then we have time to submit questions. Then another one agreed that more time to enable Bunti to think of more and have better answer, and the better answer will generate positive feedback, look for better questions. Okay, thanks a lot for these two comments and feedback. I know that sometimes I have been sending out the Slido quite late in Saturday, and then you guys don't have time to think about questions to ask. So I'll remind myself to post the Slidos earlier, maybe earlier in the week. I should send out the link already, and then whoever think of any questions or anything that you want to discuss during the weekend, just post it in the Slido. So I think thanks a lot for the comment. If not, I myself is not so don't have the discipline to do this. So thanks for the comment. This one I'll remind myself. Okay, let's go to the questions. Do you think there's a risk Tesla can grow their deliveries but can miss revenue because cut sales price means lower revenue? Okay, since Tesla just came up with their delivery numbers, usually it's like cut off of the quarter, say 31st of March cut off, right? 2 days later, around 2nd of April, or sometimes even 3rd of April Asia time. So they will release all these numbers. So this is the numbers that I pull out. Like the Q1 numbers are all updated. So usually I will look at two figures. One is what's the production year over year, because they have been communicating that they are targeting to grow 50% per year. So, and we all know that with car deliveries, there's some, cyclicality, like usually Q4 numbers will be better than the other quarters. So look at the year over year growth will be more meaningful. So they are comparing against Q1 last year. So you can see that the production grew by 44% and the delivery numbers grew by 36%. I think it's slightly better compared to the last quarter, and we can see that this is after they do the price cut, hence it helped out a bit with their sales. But if you look at quarter on quarter, you see that essentially the production number is flat, and then the delivery numbers just went up by 4%. This is because Q4 numbers is really like the cyclicality. Q4 number is better. Q1 usually is a bit more quiet, so that's why you don't see high growth quarter over quarter. You can look at the last year, also similar pattern. You see 2022 Q1 also like about flat production, and delivery also is about flat. And then the year before that, 2021 Q1 is also same, right? So I think not much surprise here. And I think in fact the delivery numbers and production number is okay-ish. It's not like much better than what is being expected, but it's like in line. I'll put that in that category. And I think the good thing is that if you put up your numbers, you can plot your own charts, and then you can see that, okay, are they having this upward trajectory, or is it like because there's demand issue, and you can start to see that the production or delivery numbers start to slowing down and so on. Once you put it in chart format, you can see that it's quite obvious. You can see in the past, let's say before 2020, like during COVID times, you can see that the growth is not like a straight line up, right? Sometimes it will came down, like 2019 here. You see 2020 also same. But here, at least for the latest, the recent quarter, in terms of the growth, I think it's still intact. But they are growing in Q1 doesn't mean that they will continue to grow in subsequent quarters. So we still have to monitor all these results. So this is just now the one is delivery numbers. This is the production number. So I think not much surprise here. So I'll say that I'm quite pleased with their Q1 results. But come back to the questions, right? I think the question is asking like, is it possible that the unit numbers grow, but the revenue doesn't grow, right? So I think I'll say just you have to look at the magnitude. So if you look at the numbers, right, here they are growing at 44%. Okay, 36%. Let's look at delivery because what is affecting their financial result is not the production, it's the delivery. So 36%, the question you want to ask yourself is that, have they cut their prices by more than 36%? So let's say if they cut by 40 or 50%, of course, with this kind of delivery unit growth, you're still not able to offset, right? but I recall their price cut isn't as much as 36%. So I still expect like the revenue to be increasing, but not as much as let's say in 2022 lah. So definitely the price cut will affect the revenue numbers, but it is of a smaller magnitude as compared to the delivery growth here. So I think no. So don't worry too much about the revenue. The revenue should be affected more by the unit than the price, at least for now. But let's say if this growth number isn't 36%, right? Let's say if it is like, let's say 15%, and the price cut keep continue like every 1 or 2 quarters, they cut by 5, 10, 15%, right? Then you have to worry about that. So depends on the magnitude. So we are basically comparing, one, how much is the unit growth, two, how much is the price cut percentage. So you see which one is larger magnitude. So for now, I think revenue will still be growing. Okay. But that's revenue, right? So another things that I think is not in this question is on the profit. Call it like, let's say, operating profit, on net profit or whatever, right? All this profit, right, it will be affected by the price cut a lot more. So I think the math is also quite simple. Let's say their margin, let's say it's 20%. If the price cut by 10%, your revenue will drop by 10%, but your profit will not drop by 10%. It will be a lot more because of the operating leverage. So I think in terms of their profit margin, it will drop quite significantly in 2023 as compared to 2022 because of the price cut. So please take note on that now. But based on the numbers, I think I did some back of the envelope calculation before. I don't think they will drop to like unprofitable level. They will still be profitable. It's just that the profit margin will be very low. So let's say later we can take a look at the numbers. I think I have something pull up something in the past. So you can look at the margin, right? Let's say operating margin, they were hovering around, let's say 15% to 20%, and the most recent quarter, which is Q4, is 16%, right? This 16% number, I think they could drop to like a single digit or even low single digit. I think it's definitely possible because of the price cut. But I don't think they will fall to negative now. So that's my own expectation. But we still need to see. We need to compare the how much are they able to sustain the current price level, or do they need to further continue to like cut the price, right? So I think these are the things to monitor in the next 1, 2, 3 quarters now. Okay. Yep, that's on the first question. Anyone want to add any things on these questions?
Hi Bunti.
Yep.
Jay here. Quick question. I think Tesla just announced a price cut again over the weekend. So just wanted to check what's your view on this? If this carries on throughout this entire year, is it a cause of concern for investors? Or you think at this point it's still not really a big concern yet? Because as they do all these price cuts, it's actually slowly sweeping up all the market shares from the ICE companies. Yeah, I just wanted to hear your view. Thanks.
Thanks, Jay, for the question. I think if I recall correctly, I saw the headline as well. I think the price cut is model S and X, right? It's not model 3 and Y. Correct me if I don't get it correctly. So you can look at the headline again. Yeah.
I recall this, yeah, correct.
So if the price cut is only S and X, right, you can see that here, right, in terms of the production, let's say you just look at the Q4 and Q1, right, production number for S and X is about flat. Like they are able to produce 20K, so same. But you look at the delivery numbers just drop a lot, right, compared to quarter over quarter. So what happened is that if they are not able to clear all this inventory, that means the inventory will build up. So they are cutting the price to clear up the inventory for model S and X lah. So this is the numbers here. Just give me a second. Okay. So then another thing to look at is that in terms of the total delivery numbers, it's quite clear that the total delivery 422,000, only 10,000 or what? This is like less than how many percent? 3%. So it's even before this quarter, the quarter before that, let's say we take 20K versus 400K, right? It's only like 5% of the delivery is for model S and X. So because the percentage is so small, and even if they do a big price cut for S and X, right? Let's say 20, 30, 50% cuts, right? It's not going to affect the revenue by much. So, or the overall growth number by much. So I'm not too concerned over this. But one thing you want to be concerned is that in comparing the profitability of S and X versus 3 and Y, right? I think 3 and Y is more, like it's more like mass market. So the profit margin is lower. But S and X is the higher margin business, right? So if this one, they are not able to sell it and need to continue to cut, right? What happens is that their margin number will be affected, but not so much about like overall business. The overall business is still a lot depends on the 3 and Y rather than S and X. That's the comment on the recent price cut.
I just did a quick Google. I think they also cut for Model 3 and Y, but the cut is not as much as the S and X. Because I think S and X they are deemed as so-called slower selling models. Yeah.
Yeah, I think I missed the 3 and Y. What's the percentage cut there? Did they mention?
I think it's 1,000 and 2,000. Let me see what's the percentage. I know S and X is about 4. Sorry. Okay, basically the headline just says about 2% to nearly 6% lah. Yeah, but I'm not sure specifically for 3 and Y, what's the percentage, but it says 1,000 and 2,000, so need to do a bit of math.
Yeah, I think don't have to be too worried on that. Especially we're talking about like very small percentage cut, right? I would say pay more attention to the trend. So let's say, right, they have been doing all this price cut, let's say over the next 1 to 2 quarters, you see that, okay, they stop cutting and then they continue to raise price, right? Then no problem. But let's say if this continue, right, like every quarter they drop 1 or 2,000, 3,000, and it just like continue to do that, right? Then I think we all should be more worried because like the first thing it hits is like the price, right, and hit the revenue and the earnings. If they continue to do this, right, then I'm dropping the operating margin drop to negative is something that's possible. So I think that one will hit the share price a lot now, because if they are not profitable, that means they are burning shareholder capitals. So I think that's something to watch out for that. But for now, because I think after the huge price cut they did announce in, I think, Q4 last year, after that they are just doing like minor adjustment here and there. So for now, I'm still watching, still monitoring the situation. But I think it's not like something that is big now. So few things to watch. I would say all these, like the price cut, price increase, that's one. Another one is to see that whether they are able to clear the inventory, or is it like inventory keep building up. So all this can help us paint the picture much better. But overall, still doing okay. If it is not okay, it's not going to grow like 36%, This time, because last year it's already like a huge increase in terms of the delivery numbers. You see, just in 2019, we're talking about like about 100,000 delivery per quarter. Now it's already 4x. So you can see that just within a short couple of years, they already increased the production and deliveries, and still they are able to grow at 36%, right? So that means that, okay, with the price cut that they announced in late Q4 last year, it's really able to like push up some demands there. So I think this is definitely a good picture, like some optimistic view on it. But nothing is taken for, we shouldn't take for granted. It's like now interest rate is still high, all this tightening still happening. Will they hit the demand over the next 2 to 3 quarters, the rest of the year? Who knows, right? So I would say Q1 numbers looks good, but coming quarters still have to see.
Actually,
Yeah,
I think
I actually agree.
there are
go
some
ahead.
other sources of data that you can look at, which is that you can look at the loans. How is the loan data like? because usually people buy cars, a good number of them will borrow to buy. So what is the loan situation like? What's the loan forecast like? Because chances are the loan data is usually in earlier than the car delivery data. So, and the loan data is usually month by month. So if you look at the loan data, usually loan affects all the cars together at the same point. So from there you can see, and then the other thing to look at would be like what is the consumer confidence, because if they are not that confident in because buying a car is usually based on obviously the people are rational, they will look at it and they will think, if I cannot pay for it or something, I'm not going to buy this car, I'll go and buy a cheaper car or something. So from there, that's another thing to look at. So it's loans and consumer confidence.
Yep. Thanks for the comment. Yeah, definitely. I think all those statistics figures like consumer confidence and so on, something to watch. But that one, I don't know. I haven't seen like a very, how to say, a very micro data statistics that only look at auto loan. I believe there's such statistic out there, so you can take a look. But usually, just look at the overall economy. You can have a sense on where the economy is heading. But for now, I still think that with 36% level of growth, it can slow down to 20%, 25%. I don't know. I still think that this is quite decent. I'm not expecting like, this kind of like what 100% growth. I don't think you can expect this kind of growth like to sustain for many years, right? So definitely they will slow down. But at stabilizing at this level, still doing okay. All right. That's the first question. When you sell your products via distributor or agent, is revenue recorded after the goods go to agent or have to wait for them to sell to customer before record revenue? I think this is more like accounting questions. So that's something that people try to point out that, okay, for Tesla business model, because they sell direct to the customer, whereas for other automakers like Ford, GM, they sell to their distributor and distributor will sell to their customers, right? So there's a level of intermediary in between. So it's slightly different when it comes to how much revenue that they can recognize. I think for Tesla, it's quite clear once they sell, it is on customer hand, so they record the revenues after the delivery. So let's say production level very high, but they are not able to sell, inventory build out. These are not sales; these are inventory build out. Whereas for automakers like Ford, GM, I believe this is what I heard from others, but I haven't really 100% verified it, is that once they offload all these cars to their distributors, it's considered sold. That's why there's some differences, let's say, when it comes to the revenue recognitions. But I think these are like, accounting is very micro to answer that questions. But ultimately, I think even like all this revenue recognition is different. But I think when it comes to looking at the revenue numbers to assess the health of the companies, I think it's still the same. Because you can't expect that for, let's say for Ford, right? They keep on offload their cars to distributor and they call it a revenue, but distributor keep holding on to those cars and not able to sell it. If they are unable to sell it, what happens is that they will also stop order from Ford and GM, right? Because in terms of inventory, how much they can keep is also like limited. So you actually have to rent a place to park all these cars. There's a limit of how much inventory that you can build out. So in terms of timing, yes, if you're comparing one quarter, because let's say Ford already offload to distributor, so it shows that, okay, their numbers is better. That's okay if you look at it on one quarter. It's a very short-term kind of view. But over a longer time period, right? Actually, they are all the same one because of this, because of the how much inventory that they can park. So I'm not too, I don't have a fuss over like, oh, the revenue recognitions, because after all, after you do these kind of things, right, you put out the chart, you can see that, oh, generally you know whether the companies is growing or not, whether how much they recognize from one quarter to one quarter, meaning that some sales can push one quarter after or one quarter before. Once you plot the charts like this, right, it won't affect the overall picture one. So if you are comparing, let's say if you do a long-term investment, I don't think you need to go into that precise level. But let's say if you say, okay, I'm looking at this specific piece of information, and you want to gauge, does it mean good or bad result for that specific quarter or that specific month, right? So I think all these micro things on how revenue is recognized will be more important. But if you just want to get the overall trend, overall macro picture right, you don't need to know like all these details one, because it's just a timing differences. It's not going to be like a sustainable, like accumulate the differences. It's not going to be like that. Yeah. So that's my comment on this. Anyone want to comment on this?
I think this person is asking how to find out, and I will assume why he's asking this question. Firstly, how do you find out whether the company states the revenue through after it has been transferred to the agent, or only when it's transferred to the customer, right? It's through the revenue recognition in the annual report. So you look at the accounting rules. It's usually at the first few pages in the notes to financial statements.
Yeah.
And the second part is why I guess this person is asking this question is because playing with the revenue number is a surefire way to is the most popular way to make your accounting numbers look good. So it's a possible accounting fraud, something that you want to look at. Yeah. So I think that's why he's asking this question.
But I don't think all these, let's say like just now I give an example of Ford GM, right? I don't think they are doing accounting fraud. To me, it's just like the way they recognize their revenue is like, okay, like what they stated. So they just consistently recognize once they sell the cars to the distributors, right?
Yeah.
So
yeah. But I mean, I'm guessing that this person is not asking from looking at car companies, automobile companies. Maybe he's really just asking this in a general way.
Oh, I see.
Yeah.
Okay. Because this question came right after the first question talking about Tesla, so I thought that they are kind of from the same person. So that's why I think whoever posts this question, please learn from Jay and at least put your numbers there, your name there, so that we know like whether they are related or not. Because if not, I tend to like misunderstood. I thought they are like linked. It could be linked, it is not linked, right? So yeah, I think that's on these questions. Thanks, Bunso, for pointing this up. Okay, questions from Jay. Given recent bank collapse, banks are tightening their credit conditions. This is expected to have significant macroeconomic effect, slow economic growth. And then second point, will be good if you can explain this to the listener or viewers. Also, more stringent lending conditions could have similar impact to Fed rate hikes. So before I comment, right, since Jay, you are here, you want to give more, background or anything that you want to share here before I comment? Or
Background, I think it's because of all the because of this banking crisis or the collapse of the few banks. I think right now the Fed is going to no, I don't think it's the Fed, right? It's all the banks. They are trying to tighten their lending conditions, so it makes our borrowing more difficult than before. Is that right? At least that's my layman understanding lah. So just wanted to hear from you, the expert. Yeah.
I'm not expert on this, but I can comment a bit more. I think that's right. In terms of the statement talking about like bank are tightening credit conditions. So I think this one we also need to be more specific. I think if we look at the larger banks, I think they have no issues. But let's look at the smaller banks, right? Like the regional banks. I think quite a number of all these regional banks, right? They do like lending that is more niche. For example, some of them like just focusing on lending for commercial real estate. So they are, they are not just banks, some of them they are like really expert in real estate. So when they do their lending to whoever wanted to buy, let's say like a commercial real estate, right? The bank themselves, they can do the due diligence, and they can know, they know that this specific purchase by this borrower on this real estate, whether it's a good buy or not buy, or a bad deal, right? So if it is a good deal, they're happy to extend the borrowing. they lend to them so that they know that even if they go default, they take over the real estate. It's fine for them because they know that this real estate is a good piece of real estate, right? So the bank themselves are expert in this area, and they cannot expert in all areas, right? That's why they stay small. They are like so-called the regional bank, and they only operate in a specific sectors. Like similar to Silicon Valley banks, they are expert in, you know, like VC fundings and so on. So they're happy to lend to all these VC because they know which one have better credit quality compared to the others, right? So they are more niche. Then comes to your questions on whether what do we mean by like tightenings, right? So, you know, like now all these smaller regional banks, they have issues. Some of them in the past, like basically what is faced by Silicon Valley banks, right, is that they have so much deposit, and all these deposit they go and buy maybe like mortgage-backed securities, like long-term treasuries. Now all this like investment already, you know, deep in the red, so their fair value is much lesser compared to today's current value. As long as they don't have to sell it, should be fine. But let's say if all their depositors like scared and they pull their money out, so what can they do? They might need to force sell all these assets at a loss, right? So they are in like, you know, their balance sheet is not healthy. That's one. So if their balance sheet is not healthy, they are not happy to do lending, because whenever they do lending, they basically put on risk into their balance sheet. Now they just want to protect their balance sheet, given that their balance sheet is already bad. So if they are tightening their lending, meaning that let's say in a lending deal, okay, that in the past, let's say 1 year before, they're happy to do this lending, right? Now they look at it, it's like, okay, better I don't do, because I need to be careful now. I already have a lot of problem on my balance sheet. So let's be more cautious. And if they stop lending, that means the borrowers, even they look at the property they want to buy, they are finding it harder to secure financing. Or if they are able to secure the financing, they need to, you know, pay a lot more interest because of the so-called the risk is deemed as much higher compared to just 3 or 6 months ago, right? So all this effect, right, will have you know, lead to a situation where there will be less transactions, less economic activity, because now less money flowing around, because essentially all these banks, they are, you know, like they are flooding the markets with capital once they do all this lending. Now the capital, they tighten the capital already. So there will be less transaction, less economic activity, and so on. So just take away all this rate Fed high and so on. Just the bank tightening alone will actually cause like you know, tightening effect lah. So they will help to slow the economy, because once capital tight means that you have less money floating around. So harder to secure financing, harder to get money, harder to get people to invest in your companies and so on. All these are together we call the capital markets, right? When the capital market is tight means that it's hard to get liquidity, hard to get capital. So once this continue, it will definitely have some impact. Like it's quite similar to the Fed tightening effects. I think Jerome Powell also comment on this. He said like all this bank tightening is equivalent to don't know how many hikes. I forget the numbers. Maybe like 2 or 3 Fed hikes. So that's why if this one continue on the regional banks, right, all this situation with bank crisis continue, what happens is that Fed don't have to hike so much already, because the bank themselves will already help to tighten the market and will help to cool the inflation. So central bank don't have to do more. But let's say if overall, like this Silicon Valley Bank, the situation is more like just a blip, right? Then after that, all the banks are happily do lending again. Then of course, inflation will stay high, and Fed have to do more. So I think all these things is like very fluid one. The situation is not like static. So it will keep changing depending on what the banks are doing, and depending on how the consumer are doing, depending on what the government is doing when it comes to their fiscal spending. And combine all together, then Fed will jump in again to help regulate. So many parties doing their own things, right? So that's why macro is like, you can do all this study, and in the end, can you really predict or not? Is the other things are quite hard to do all this prediction, because there are too many moving parts and too many players. But come back to your question, is that yes, whenever banks stop doing lending, stop doesn't mean that it dropped to zero. It just like dropped significantly compared to previous quarters, right? You definitely will feel the tightening effect, and that will slowing down the economy, and also with that helping with the inflation, cool down the inflation. Okay. I think I've answered this. Anything to add from your side, Jay?
No, thanks for sharing your view. But just another quick question, because I think the earnings season is it will get underway this coming week, right? With the big banks reporting their earnings, I think on Friday onwards. Any views on this? Say, what can investors of banks look out for? At the back on the backdrop of this whole banking crisis. Like for example, the deposits money, or are we expecting to see that the money will start to flow from the smaller banks to the big banks? Basically anything that you think investors of the banks can keep an eye on for this upcoming earnings?
Okay, I need to be honest here. I'm not expert in looking at banks. I have totally no clue when it comes to studying banks, income statement, balance sheet, and so on. But on this, I have something to add. Is that you shouldn't just look at bank overall, because what is happening with the large bank versus the small regional banks are very, very different. So I would say that if you are interested with the large bank, right, you should pay attention to that and do that study. And you shouldn't be that concerned with all this, bank run and so on. Because let's say if there's a bank run, actually the larger banks they benefit from all this bank run. So the dynamic is very different. Need to separate the large bank and small banks. Yeah, like the smaller banks, I don't think you need to wait until the quarterly results. Actually, I think all these deposit, whether depositors are running away, all these things, I think there are some disclosure or some other data points that can help you with this. Maybe Fed also have some disclosure, and you can take a look at that. I think that's on the small regional banks. But even so, even if you look at that, I think I don't think any of this disclosure will help you to predict whether there will be the next bank run in the future. Very hard to predict. That's why even Silicon Valley banks, right? If 1 month prior to that, even if I spend, let's say, like entire weekend to study, I can tell you that there's no way that we can predict there's a bank run happening at Silicon Valley banks. So very hard. So that's one thing on the on smaller banks. But overall, in terms of the risk, yes, all these bank run and so on still affect their business model. And if they can't, like they face all these liquidity issues, right? I think the worst case is that they will be sold to the bigger banks and just capital wipe up for all the equity holders. So if you are investing in smaller banks, that's always the risk that you are taking. Okay, so that's small banks. But for larger banks, right, all this bank run not a problem, doesn't mean that, okay, you can just safely buy the larger banks and no issues. I actually disagree with that. The reason is because I think for the larger banks, the largest risk is not bank run. It is more regulations. So let's say with all this situation happen, right, there's always, people will push for more regulations to, so-called protect the depositors and so on. Once all these regulations keep on, like restrict their hands, what happens is that they basically can't do things that is like having higher profit margin. They can't take risks. No risk means no returns, right? For the larger banks. So it doesn't make sense to invest in larger banks if their hands are tight. Also, you will get such a small, like very low profit margin. It really doesn't make sense, So I think regulations is something that I would think is a large, major risk for the large banks. So their dynamics is very different. So you need to like know which one that you are looking into and understand that whether all these like regulations or will impact them or not. So that's just like small, input from my side. In terms of how to analyze their statement, I think there are other people maybe can comment. I don't know, Boon Song, you want to comment on or any others?
I think banking is a confidence game. So all the banks are technically all insolvent because it's all fractional banking. It's the truth. There's very, very few 100% reserve banks. There are some, but it's not in USA anyway. So if you want to talk about banking, right, and whether there will be any shocks, it's all about whether anyone report on any issues. So if there's no media noise and there is no insider noise or insider or like investors pulling out their money or like these kind of things, like you see the VCs themselves, the reason why the Silicon Valley Bank kind of like, it was not really that bad of a situation. It's just that the moment some people saw the early results, right, they really start advising that those VC firms to pull out their money quickly. Like Peter Thiel, they flee at the first sign of danger already. So the moment they flee, because of how the numerator and denominator works, you remove the denominator by equal amount, you get a very high you'll get a very high ratio no matter what. So with that, then everyone starts to like flee, and then that kind of thing happens. So probably if I were to look at it, I would look more at the media reports, and if I have some kind of information like insider information or hear noise from the industry that because usually this type of thing is, there is like some people that will have like some information leak out or something that, oh, reports are going to be bad or whatever things, then that's the case but if you don't have that kind of privilege of knowing, right, then it's very hard to make any kind of decisions anyway, because banking is a confidence game.
Yeah, totally agree. Okay, thanks for the comment. Let's move on. The streaming business, Netflix, Disney, Paramount, Prime, seems like subscribers can just cancel. Is it a sustainable business? What is their competitive advantage? Y6, you want to comment on this?
I think competitive advantage is that there's always going to, I would classify it as interactive and non-interactive media. So interactive media are things that you have to press around, basically not brain dead. You have to press something or do something like games or like whatever, type comments or stuff like that. So there's the other whole segment, which is non-interactive media. And non-interactive media, if we were to class it as a whole, right, then we have to look at the entire thing, which is obviously streaming has kind of overtaken cable broadband. So cable broadband is really dying, probably dead already or something. And the other thing is movies. So movies and those theater, these kind of things, if we look at the numbers of theaters and the even though the pandemic has gone and is more or less over already for the USA and things, but the theaters have not reporting very good results. There was a surge back immediately after like the reopening, but now they're back to like this kind of lukewarm results. They're not back to the kind of numbers in the past, and it doesn't seem likely going forward that they will hit back the same numbers back before the pandemic. Like we can kind of consider the peak point of pre-pandemic was like at the Endgame movie or something. Then after that, everything just kind of dropped already. So that is the issue. So if we can just look at the two of them, and you can see that for non-interactive media, so long as the movies are not getting much traffic, it means that people are getting their fix from somewhere else, which is from this area. And relatively speaking, in terms of like how much they are paying per month, I mean, there's a lot of complaints that say, oh, this is raising price and we are not going to pay or whatever. But those are just online bubbles, echo chambers that once you look at the numbers, people are still paying because it's still relatively cheap entertainment. Like 15 to $25 a month is still very cheap. Then it's just a matter of whether they are competing among themselves. That means like some people will sub Netflix, some people will sub Disney, and then from there, that one, if we were to do like more of like in-depth analysis, it would be I would to say like to see how many different genres each ones are bringing in, and how many old and new films that they are bringing in, like on a month-to-month basis. Then that's how I would analyze this area. So currently for me, I see that I'm not invested in any of them, but from what I see is that Netflix does have the dominant position, and it doesn't look like Disney is doing that well, and the other HBO is kind of also doing somewhat okay, but Disney is the one that has a lot of issues because they have like a big Disney catalog, but it seems like they have a lot of issues trying to bring in things that are more varied. Their genres are just quite limited, yeah, compared to Netflix and HBO. So that's my view on things. Yeah.
Thanks for the comment. Yeah, I think on this, right, my view is that first thing, let's say for Netflix, they are profitable now. I think that's the number one thing. So if let's say if they are burning capital and so on, they're not profitable, then we can of course question like can they become sustainable and profitable. But the fact is that they are already profitable. They are collecting, like hundreds millions of users. Everyone collect like how many dollars, right? So it's enough revenue for them that after subtracting all the cost of production and so on, they're still profitable. So I think that's the more important one. They are profitable, meaning that there are enough user, even though they can just cancel, but they didn't cancel. They just pay the subscription month over month, right? And they are in large enough sticky business that make this business model work. So I think that's my comment on this. And one thing I can share is that I just look at my own like personal spending. I think in the past, right, I actually quite want to be careful not to subscribing things, because I think that once you subscribe already, you just keep on paying. Sometimes you're not using, you continue to pay. So I'm actually quite careful when it comes to subscribing any services. But actually, I noted that lately, after there are all a couple of like services that I'm using, I'm actually like find it quite okay and quite happy to be paying. I think the number one example is Zoom, the one that we are currently using now. So I'm actually paid for it, and then I'm happy customer because I think that their service is still better than the other competitors. I think there are free options out there, but Zoom is still better. The other one that I'm subscribing is, let's say, like all these like ChatGPT, I also subscribe, and then Spotify I also subscribe, and all these become like, for me, of course, whether I'm using Spotify every month or not, sometimes it's like questionable, but I don't have a feel to say that, oh, let's cut my spending and unsubscribe and so on, right? So because they are low enough not to trigger this kind of review on spending, and at the same time they are giving a good value propositions when it comes to delivering good content and so on. So I do think that the business model works. It's just that whether it gives you a good ROE, and what are given that they are already so like in terms of market share already so big, say Netflix for example, right? How much can they grow further? That's another questions, like all this DCF and so on. You can definitely say it is not a good investment, but when it comes to the business model, I do think that it works. So that's just the fact, right? Unless you are looking at their subscriber numbers keep dropping, and you start to get worried, that's another story. But for now, I think they in terms of the business, they already achieved the scale, and with that scale, they are profitable, and it is sustainable, in my opinion.
I
Unless
also think they have a cadence, right? In terms of
Mm.
at the start, the big concern about like 1-2 years back is that Netflix might overspend on the studios and then bring out a series of films that nobody watch or nobody subscribe to watch, and then they spend too much on those studios, and then that is where it becomes like their cost of goods sold is too high. That was the main concern. But seems like after the past 2-3 quarters, right, people kind of like see that Netflix has got down the formula already. So they have like these studios that are kind of in long-term contracts with them that will produce out things that people will watch, and we kind of see that there is interest, and they also have studios that are all over the place. So it's not just like very like formulaic just US films and series, but you can kind of see that there's series that's all over the world that's happening. And I think the rest of this streaming business, they are all trying to get in on this that means get down this formula as well, because once they get down this formula, then they can kind of like produce out the same kind of same kind of results that give investors more assurance that it is a sustainable business model.
Yep, thanks for the comment. Okay, let's move on. Okay, this one quite interesting. Let me read out first. Temasek GIC returns over the long term underperforms S&P 500 by a lot, and consider they also deploy leverage. Why opposition never bring this up in parliament? This one, let me share some findings first, and then I'm interested to hear YCX view on this. Actually, I pull up some information. Okay, this is the one. So let's look at the numbers, and I look at the 20-year period because I can find numbers for both GIC, Temasek, and S&P 500 now. Okay, so for GIC portfolio, they achieved annualized USD nominal rate of return of 7% over 20-year period. And this is cut off until 31st of March 2022. So I think you need to wait maybe a couple more months, even until July, I think, maybe end of July, then only you get this year numbers, which should make these numbers slightly lower. But let's say I think for 20-year periods, I think not so important. You do whichever cutoff. So we just standardize the cutoff. GIC 7%. Okay, remember this number. Then Temasek also same 31st of March cutoff 2022, and they actually explain what is this TSR, total shareholder return. But I read this out. I think they are the same. They are basically the investment return, the compound investment returns. So the returns over 20-year period is 8%. So Temasek actually outperformed GIC. I think when it comes to their allocations and strategy, I think Temasek focus a lot more on those illiquid investment, say for example like VC, private equity, and so on. And I think they focus a lot more on Asia, Singapore and Asia as compared to GIC. At least this is my like very surface understanding. Could be wrong. Please verify that. I think these are all available on their website. So don't worry. If you are interested, just go to their website. Okay, next one, S&P 500. I think this one, I use the calculator. I hope this is the correct one. I think you can just do this Google search. You will be able to find this site now. So basically, they include the dividends in the calculations, and I do March to March now. Maybe this one I should put April. I don't know whether they start from end of the month or beginning of the month, but doesn't really matter when you look at 20 years now. So annualized S&P 500 returns dividend reinvested, the number is 9%. So quite interesting. From 7% GIC to Temasek 8% to S&P 500 9%. Okay, now come back to the questions, right? Temasek GIC returns over the long term underperform S&P by a lot. So yes, I have verified the numbers. Yes, they underperform S&P, but not by a lot now. Say for example like GIC underperformed by 2%, and then Temasek underperformed by 1%. Okay, so if you ask me whether this is underperformed by a lot, I would say not really. 1 to 2% isn't like a lot. For those like a lot one, you can have like, let's say 5%. It could happen, right? So I do think that 1 to 2% is actually quite okay. But underperform means underperform. We don't have to sugarcoat this, right? So now I want to invite YCX to share your opinion. Why opposition never bring this up in parliament? Or if you want to comment on the returns, also feel free to comment.
So I'm looking at let's just look at Temasek because I think GIC and Temasek, I just go to the Temasek website right now, but pretty much the things I say will apply for GIC as well. So if we look at S&P 500, they are just an index, and their purpose is just to take the top 500 companies and allocate accordingly as that. So they have their own, that is so-called like their mandate. Then when we look at Temasek on their website, their mandate, they says that our purpose statement is so every generation prospers. And it says we aspire to help every generation thrive by empowering blah, 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 but also for future generations. And then they have a lot of things that says here, human potential, solutions, courage, generations. So basically, it's the same kind of things whereby if you look at it, but the main important things is that they say here, our guiding purpose, why we exist. it says that alignment and direction in the face of uncertain and complex times, right? So if let's say you are a director of Temasek and you are being you just put yourself in their shoes, like you are the director of Temasek and like you are being given like hundreds of billions of dollars that you have to invest for the country, and your purpose is really very clearly stated out here that you are supposed to invest for the prosperity and the generational prosperity of Singapore. Then you think about this and then you think, hey, so should I be actually looking at just like the returns? That means even let's say over a 20-year period, I underperform SP 500. Should I actually be concerned about that, or what am I exactly concerned about? Then from here, there are a few things that to look at, which is that it's always about the black swan events, because when things do well, right, Temasek, nobody will talk about Temasek or complain about Temasek or anything. But when there are black swan events like 1997, 2008, 2020, like that, right? How is Temasek doing during then? Then that is the point of contention, because even if you have opposition who will bring up these things, they will only bring up if, let's say, during a bad year like 2008 or 1997, that Temasek vastly underperformed SP 500, then this kind of thing will come out, and then these people will start to talk about, oh, okay, what exactly is Temasek doing? What exactly is GIC doing? How come we are underperforming so much? This type of questions will only come out during those kind of points. So immediately you can see from a risk-averse kind of behavior how you would invest, right? Because this is your number one concern. Then the number two concern would be that when they invest, they have to invest according to like what they will actually benefit Singapore. Because sometimes when they invest, right, because they are a major shareholder when they invest in certain companies or funds, then they can actually influence how these funds or companies go about doing their business. So they could actually like say, hey, there might be some kind of deals or whatever that they can just make, like say, we're going to invest in so and so particular company, but in return you all must come over to Singapore to set up some kind of company or create jobs in this area, or this kind of things. So they have this kind of things that are going on that is not exactly well reported, but if you think about it, it makes sense, right? So from there, like let's say even for the recent case whereby 2020, there's definitely some amount of backroom leverage that Temasek or GIC do that brings these medical companies over to Singapore instead of to some other countries. So there is that point as well. So these are the two main points in which, if you look at Temasek and GIC, they will probably think in this way. Yeah.
Thanks for the comment. Yeah, I totally agree that this is like their business or their operation is not really like any private fund managers where their job is really just to beat the benchmark, right? So these are sovereign wealth fund. So in terms of their mandate, they are not the same as private fund managers. So we definitely have to take note on that. And there are all sorts of other things as well. Like just now you give a few examples. I also can give one, right? Say for example, during COVID period and SIA have some problem. I think all these like Temasek or GIC, either I forgot which one already, they might also like use their money and to support the company just for the benefit of the country, and not so much like, let's say if you are a private investor, you won't put your money in there, but as a sovereign wealth fund, sometimes supporting this company during tough period is something that makes sense to do. So there are all these things that may affect their returns as well. We don't know. But I do think that you shouldn't look at them as any like a private investment managers. You should read out their, like their vision and mission and see whether what they are doing is actually helping them to achieve the missions. So that is more important as compared to like just looking at returns and returns and returns. So I think that's something worth to point out. But back to the returns, I still think that the returns off by, let's say, 1 or 2% isn't that bad. You can, anyone, if you have any friends that do their own investment, you can ask them like what's their track record. You will notice that actually like quite a number of people underperform S&P 500 and underperform by a lot, not just 1 to 2%. So you can ask around if people, your friends, happy to share with you. 1 to 2% isn't a lot. At least that's my personal opinion. Okay, I think anyone else want to comment on this topic?
Oh yeah, also their size is so much bigger. When they invest, they actually move markets. So
yeah, definitely. Not easy to invest. Even like Buffett also keep complaining about the size. Not much things that they can do because of the size. Okay. Next one. In your opinion, who are your top 5 investor in the IFLT group, and what can others learn from them? Okay, this one I asked YCX first. You want to comment on this?
In terms of what, like,
I don't know.
what does it mean by top investor? So
Yeah.
is if go by just returns, I would say whoever make the right calls is the top investor. If you just look at returns, then that's the answer already. But then sometimes it's about like what the people invest for different reasons, like there's also like like sometimes it's just they're investing because they have like it's kind of like you cannot just look at returns and then just think, okay, whoever makes the most returns is the best, because if like that is saying, then we can also say whoever bought Tesla course during the 2020 and ride all the way to 1000 is the best really. There's nobody that can beat the Tesla course really. Then they will be probably the top for the next whatever number of years, because if you talk about that one, it's straight away win already. Correct? That's the kind of things. But then sometimes it's more about like, if you're talking about learning, then it's what you want to learn. Like if you want to learn about dividends, there's many people who are very good with dividends. So I mean, I myself, I'm not good with dividends at all. Then I cannot even talk much about dividends. There are people who are good at rates, and you have to look at them talk about rates. I myself also don't know much about rates. My rates knowledge is probably close to like what, if compared to other people, I don't even know, half the time I don't even know what they're talking about. Yeah, you see, this kind of things. But then if you talk about like some tech stuff that's related to AI or crypto, I probably know more than the average investor out there. So is what strengths and weaknesses you want to look at, and then you see, and then if you're just talking about copy trading, then you just take whoever is. There are way many copy traders out there. There are many platforms that you can just search for copy trading platforms on your app store or whatever, and then there are those that straight away give you like the top performers, and then you can straight away take it from there already. Correct? I mean, that's what I think. Yeah.
Yep, 100% agree. Yeah, I'm thinking about the same things that you asked just now, like top 5 investor. What do we mean by top, right? In fact, so many people have been commenting in the group, but yet I don't know like the returns, right? For YCX, I think I remember I asked your returns, I think maybe last year, like I did ask that, and then you did share. And then also this kind of things is not something that we so people want to ask hey, what's your return this month? What's your return this year? Or all these questions. One thing is that sometimes like when people ask, okay, just to satisfy the curiosity, that I don't mind to share. It's just that what can you learn like from me sharing the returns or my returns, right? Even if I make the right calls in the last 2 years and then I have a good returns, doesn't mean that I'm as lucky moving forward, right? So I think that's why sharing returns number isn't something that is like, doesn't help with the learnings. So I think good thing is that we also didn't discuss so extensively about like our returns. So I don't even know who has the best returns in the group. So that's why it's very hard to see like who has the highest returns if you take the returns as the proxy for good versus bad investor. So that's on the returns part. But I will comment on this based on like pay more attention to how much we can learn from each other, like what YCX just said. So I think there are so many comments, and good thing about Telegram is that we can keep on prompting, seeking clarifications, ask for elaboration, and so on. So this one definitely can help with the learning. I won't give the list of the names. I think those active one you guys know. You actually one thing about Telegram is that you can see that whoever gives some interesting insights, right? People give a thumbs up. I think that one serves as like something like a recognition that okay, people agree, or you are adding benefits or adding values to the communities, right? I think this one you can take it not like a scientific measure, but it's more like something like a signals to tell you that oh, people actually agree, right? So I think yeah, that's the thing. See how much people can add value in each topics rather than asking who is the best. The best, you definitely have to look at the returns. Even for let's say like in the professional investment world set up, right? Whenever you study a funds, I think it's very hard to get away from looking at the returns. I think this is just the fact, right? It's very hard. Let's say I want to recommend you this fund, right? Oh, this fund super good, investor super great investor. Talking all the good things about this fund. The fund managers is fantastic, but their track records, they've been operating for 10 years. Their returns is -5%. So what do you feel, right? Definitely you think all these are bullshits, right? Number one is returns, and how do I comment this without knowing the returns of every investor? So very hard. I would say that you need to know what's the returns in order to judge whether this person is good or bad. But with the investment return, you don't know whether that one is a skill or is that just a luck. So
then there's also sometimes it's about, usually people look at returns, they think that returns is just consistent, wow, every year 10%, that kind of thing. But then in reality, there are some years in which I have like, I mean, if we just talk about stocks, the numbers are much lower. But if we talk about crypto, Bitcoin, these kind of things, right? And if I just factor in the Bitcoin numbers, the numbers will look horrifying to people, you know? Like you see the numbers of Bitcoin go like from like 6,000 all the way up to 60,000, then back down to 20,000. You think about it, it's done through like over when 60,000 dropped to 20,000, that's over like in a year. Actually, it's in not a year, it's in less than that. It's in like 4 months' time like that. Then you see, if let's say we just take into account Bitcoin holdings itself, right? Then I can say for 2022, my numbers dropped like crazy if you just look at Bitcoin. But if you look at then it becomes like it's also about what are you trying to learn from here, because of course if you are going with this kind of volatility, then you are going to get this kind of numbers. And I've also pretty much stated that the reasons for holding Bitcoin or the reasons for holding certain stocks or this kind of things are because when we look at all these investments, sometimes people invest in a different way because they have some kind of income stream or they have some kind of sectorial knowledge in whatever they do. That's why they invest in a certain way. So it is hard to actually know because people, like you can see that maybe maybe let's say somebody's fund actually dropped by a lot, but then could be that they have some other stash somewhere else that actually is balancing out this area, that kind of things. You also don't know.
Thanks for the comment. Okay, this one also interesting. I have no idea one. Let me read out first. Cloud is its competitors of old IBM, meaning if they use cloud, they will shift from IBM. Thus, IBM keep dropping. Not saying IBM cloud. I think what this question is trying to say is that nowadays when we talk about cloud, we are talking about like AWS, Azure, Google Clouds, all these like big platforms. And then basically they are competing with what we call the on-premises servers. And these on-premises, I don't think it is all IBM. Actually, if you study the companies operating in those areas, there are quite a number of them. For example, like Dell, they also have selling all these on-premises servers and so on. So it's an ecosystem for on-premises. Whether it's IBM or not, I think IBM is one of them, but not the entire thing. And different companies also doing different things, right? So come back to this question is that I think it's asking about like, okay, are they talking about competitions, right? I don't know. I think IBM also have their cloud offerings, but it's not like big percentage compared to their legacy business. I think IBM is trying to get into more on the software side as well. But I a bit struggle to understand what's the questions here. I think there's another one comments that talk about this. Let me look it up. Can't find it here. So it's okay. Well, let's see anyone want to comment on this, comparing all this cloud and talking about IBM. Anyone have any comment?
I think because I know the tech industry, right? And there's always this cycle that people who are not in the tech industry don't really see that, but actually this cycle happens all the time. So the tech industry, I mean like the computer industry actually only started in like 1960s in earnest, and IBM was the number one back then already. So when IBM first started, a brief history is that they started with like those monolithic things like on-prem servers, mainframe, this kind of thing. You think about it, it's like every company owned their own, and then because back then there wasn't an internet. There was just your own computers, your own data, and then you do your own calculations for your own company. That kind of idea. Then after that, the internet came in, and then there was this personal PC, Microsoft, all these things come in. Then it becomes more democratized, and then you start to see more moving towards like the personal computer kind of things. And then at the same time, you also see that for software, right? It used to be that the software is monolithic software. That means like monolithic software is something like Excel. Excel is like a monolithic software. Microsoft Word, monolithic software, because it's like one app do a lot of things. Then you see there's a slow trend and shift towards APIs and like AWS, this kind of thing, whereby you kind of like pick and choose from the API what are the things that you want to do, and each API command only does one thing. So you just pick and choose, and then you build out your own solution from there. So you can kind of see that there is a move towards cloud in that area. But from now, what I see is that going forward, it's not going to be that clear cut. It's not going to be cloud is the way to go and its API is the way to go, because now we are entering the next era, which is that all these companies, right, will start to think of there's really a mindset change. The previous mindset before all this generative AI thing is that it's okay to put out your own data, like some portions of it out online, and then people can use it and then generate value for you, and then you can use it as like a kind of like a cooperative way of doing things. But with the advent of generative AI, and especially now that they are getting so much better, right? Companies are not going to be that willing to share data anymore, because any data that's out there, if you are sharing it and your competitor isn't sharing, it means that you are at a disadvantage. Your competitor can just they don't need to dedicate much resource to actually analyze your data. They can just have like a generative AI do it for them, and then they can just compare on the fly your data versus their data, and then get some kind of insights from there. So data is going to become more proprietary, it's going to become more close, less sharing. And then all these cloud kind of things, for those companies with valuable data, they will start to move more towards on-premise servers and things, and build out their own generative AI that's only internal usage only. So that is the trend that I see going forward for the next 3 to 5 years, because of just this disruption in the technology that is coming ahead. So I don't necessarily believe that cloud data and all this API thing is going to be permanently the way forward. And in fact, I think that there's going to be a reduction in this area. That's my own view on how things are going to play out because of the data and generative AI.
Yep, thanks for the comment. I think quite very insightful on talking about like all these trends, and sometimes like stuff like generative AI, they definitely how to say, shake our thinking of how to move forwards, right? Like the value of the data suddenly just skyrocket after GPT came out. So this one definitely not something that we can see coming, let's say just a couple years back, right? So definitely agree on that. But comes to cloud, I think like you need to remember one things on this is not like static market, and then $1 gain in cloud sector means that all these like on premises will drop by $1, right? It's like the entire ecosystem, the entire development and trend, they are still growing. So there are so many new things, right? Say for example, like GPT that came out is essentially an entire new area that they are not eating market share from others. They are actually create entire new things on themselves. So I do think that if you just look at, let's say, cloud, for example, I don't think they are slowing down. In terms of their growth, they will still continue to grow. In fact, there are so many services still operating on premises that it make a lot more sense to move into cloud. So I don't. For me, let's say like I invest in AWS, Amazon, and Microsoft, right? I think in terms of their trajectory, in terms of their growth, they're still quite intact now. So I'll move into these second questions, and then I will show the chart later. In Southeast Asia, do companies use AWS or Azure? If yes, what is the percentage? Else, what do the companies use? Is it they have to build their own server with hard disk? So I think the general comment is that before all these companies move into cloud, right, and they want to set up, they want to share any information, definitely they have to use server, what we call on-premises server. Actually, server, right, if you think about it, it is just a computer. It's in terms of their, like their setup, it's the same. They are just computer. In fact, you can use your own computer as a server if you want. It's just that there's some limitations. That's why when you are using so-called server, they let's say like all this bandwidth is a lot larger as compared to just a normal PC. In fact, I've written, let's say like a bot in the past, and you can use your own PC as a server to do some response, right? So it can work for like, let's say people like let's say 10 or 50 people call into your bots and give a response. But once this number become much larger, then your PC will crash already, can't satisfy all this demand, right? So I think this is on premises. And one thing good about all this cloud is that they are scalable, means you can rent one course and then you can rent more course. You can rent certain gigabytes and then you can rent more, right? So it's very scalable. This is always the selling point of all these cloud platforms. And if you look at their trend, right, in terms of the market share, I try to find those market shares that's relevant to Southeast Asia or even Asia. I actually can't find good informations. But I think even for Asia or Southeast Asia, companies like Amazon and AWS and Azure, right? These are still the number one and number two players. So I think they are not too different compared different regions. Maybe if you look at China specifically, definitely it will be different. But if just look at Southeast Asia versus various region in the world, I think in terms of market share, they are quite similar in the sense of AWS is still the largest one, followed by Microsoft, followed by Google Cloud. Then number 4, I think Alibaba, this is also quite big, and the rest. I think the other big one is I think Oracle, and then maybe who else? Yeah, Oracle, IBM, these are still the large one. So yes, in terms of the market share, I think if you want some growth in terms of market share, I think Microsoft is still the one that has shown a clear, sign of increasing market share. AWS is more like just maintaining their percentage of market share. They can't grow much from here because Microsoft is like really challenging them. And I think when it comes to offering, right, AWS is still better compared to Microsoft, but Microsoft definitely they have edge because for all these like enterprise that is already using Microsoft Windows and using Microsoft Office, I think their offering is just like in terms of integration with the existing product suite. I think Microsoft is just much better. I think they have some edge there. And in terms of their sales force, I think it's also very effective on leveraging all this strength. So I think this two is still the main one. The rest, I don't know. I haven't really paid too much attention onto, like, let's say Google Cloud, Alibaba, and so on. So I don't know whether that answer these questions. Anyone want to add on this? Like, do you have any insights when it comes to, like, Southeast Asia or Asia in general? And if you want to comment on these questions.
I just want to add to the previous thing is also that the more cloud that people use, right, because it's internet accessible, and there's always chance of like employee errors or things, it's easier to actually have data leakage compared to on-premise server and internal intranet kind of things. And with regards to like, due to now there's this kind of generative AI things out there, the moment you have some kind of big data leakage, it becomes very easy for people to train on your data set and to draw out actionable insights before that data becomes useless over time. So that is one thing to consider in terms of security.
Yep, definitely. I think for those looking at security, you have totally different considerations. Like some even say, okay, for on premises not enough, you still need to air gap it, especially for those working in defense and so on. There are a lot of considerations now. Okay. Okay, next one. Tesla buys SolarCity. They bought SolarCity, I think, quite a number of years ago. So far, is this solar segment of Tesla performing versus their competitors? How much market share they have? This one, I put up some information. Let me pull it out. Okay, I think this is the numbers. I think for Tesla, I think just now we have one questions talking about like Model S and X dropping prices, right? Is it like they have a huge impact or not? I think that one I say is very small if it just affect S and X because of the small market share, right? And then the other things to look at Tesla is that the energy generation and storage segment, right? If you look at this segment versus overall revenues, right? I think this is also very small. You see, total automotive is already 77 billions of sales in 2022. And if you look at energy generation, it's only like 4 billions, right? It's very small. So one thing to note is that, okay, if you watch some Tesla video, people will say, oh, energy generation will be something, will be a catalyst, right? So I think, yes, you can call it catalyst and you can say that this is an area that is still huge room to grow. I agree with that statement. But if you look at their current scale, which is, we're talking about like 4 billions, they can double and double, okay? Meaning from 4 to 8, 8 to 16 is still very small as compared to the automotive business. So that's why if you look at Tesla, whether good or bad, and if you want to monitor upcoming few quarters, I think it's still the Model 3 and Y that's driving their revenues and not so much about the energy generation and storage. But if you look at 10 years ahead, definitely this one can grow to a much larger numbers depending on how good they how good are they at executing their plans. Definitely can grow. There's potential there. It's just that they are very small. I think this is something worth to point out. Then if you look at some numbers, right? Okay, that one is talking about their share versus Tesla auto business. But I haven't looked at their share versus their competitors. Actually, I can't find numbers given that I only spent quite a short time to research on this. But if you look at this number here, Tesla energy storage deployed, okay, at least one good thing, one thing you can look at is that, okay, it's growing. I think definitely good sign here. And then if you look at in terms of their offering, there's some news to say that, okay, their Powerwall, all this, there's still some new products that coming up. Say for example, the Mega Pack. I think there's some deployment in 2022. So definitely something that is helping them increase their scale in this energy storage business. So okay, I think this is easier to understand, right? The Powerwall is the smaller one, and then Power Pack is the slightly bigger one. And Megapack, I think this is like utility grade services. I think they are selling to Australia, if I remember correctly. So these are their product offerings with regards to energy storage. Then the Tesla solar is completely different. This is talking about the Tesla solar roof. If you look at their growth, right, they aren't growing very like healthily. You see, it's kind of like stagnant as of now. I think they have some problem competing with their competitors. That's why you see it's like more like a flat rather than growing. So in terms of their offering, you have Tesla solar panels and then solar roof. I think this is like not much traction. I'll blame this to executions, but in terms of what are the details why they aren't growing a lot, I don't know the full details. Maybe whoever know the details here, maybe you can share your research. So come back to this, right? Is that okay? How much market share they have? I have no answer to these questions, but I would say that just like overall comment after we look at the couple of slides just now, right? If you talk about the energy storage, I think they are doing okay there. In fact, the Megapacks, this is like I think they have some growth in that area. But when it comes to solar offering, I don't think they are doing that great. So need to separate these two. But even so, after you add up all this together, it's still a very small business as compared to their car business. So please take note on that. So I keep saying this is because some people they are very, how to say, they're very bullish on Tesla solar business, Tesla energy business, and energy business can be as huge as their auto business. They keep talking about this without looking at the numbers. When you look at the numbers, you see that actually it's just 4 billion business. It's very, very small. It's as small as you can compare this versus Apple airport business may even be larger, right? So that's why I think you can be bullish on this, but need to look at the numbers and assess your sentiments. Sometimes I think after you look at the numbers, you would think that, okay, let's be realistic. If we want to track their business over the next couple of years, still the car business is the one that is growing and growing a lot. Okay, and not so much about all the other segment. The other segment, we need to wait until they prove us wrong, right? You see, let's say there's a couple of quarters, they show us that their energy storage business is growing at 80%, 120% for, like 8 quarters. Then that's different story, right? But looking at their current growth rate, right, which I think is shown here, you see 2022 versus 2021, their energy generation and storage, they grew at 40%. This is even lower than their automotive sales, right, which is growing at 52%. Usually smaller segment is easier to grow at 80, 100%, right? But not the case. So, okay, I think this is from Tesla 10K. You look at just one table, you know that, okay, should we that bullish or not? My response is no. So, okay, that's a comment on this. Next one, Tesla valuation is due more to manufacturing capability than tech or growth. EV got nothing tech. How is their other competitors' manufacture capability versus Tesla? This one, I think you can break it down also. It's not just, I think manufacturing people tend to look at it as if it is one thing. I think that shouldn't be the case. You can at least break down, let's say, their battery. I think Tesla is trying to build their battery, right? The 4680, but still they are importing a lot of like batteries from BYD, Panasonic, Catel. So you can see that even talking about battery, they are not like super dominant. They are still quite small there. So that's on the battery. But aside from the battery, you should look at other area as well. For example, like the overall manufacturing. If you listen to the Investor Day, they talk a lot about the manufacturing, different area, different segments. So that one can definitely give you some sense on whether how good are they in their manufacturing, right? But I won't conclude so soon that, okay, their manufacturing is like, okay, like much better than their competitors, right? Sometimes it's not like who is better. Sometimes it's just like, okay, different companies doing different things, try to solve the same problem with their own ways. Which one is good or bad? Hard to say, I would say. Definitely, I'm not expert in this area either, so I'll stop here. Anyone want to comment on this?
Hi, Kelvin here.
Kelvin. Yes.
Regarding this point, right? I'm not sure how there's a lot of things to break it down, like what you say. You cannot just say that Tesla is the best in manufacturing and then BMW is the best in marketing or what, because it's a very complex product and each company has its own strengths. And then what I think we should see is that look at what is more important towards the mission, because you can see that some companies, they, like, let's say, like if you look at Mercedes, you see, wow, their car got very nice lights, very luxurious materials, but is it what you expect to bring forward that technology, or is it what you expect to really make money in the end of the day, right, as an investor? So like Mercedes, they have their own vision. BMW has their own vision. BMW, they have all the while saying that they're going to be the car is the best drivability or whatever, right? So you look at what they are the best in and see how they execute that. So for Tesla recently, people say their manufacturing capability is the best, right? Why? Because recently they show their investor day and then they focus on their scaling. So that's why now everyone was saying that they are best in the manufacturing, but it might not be the case also. So it's better to just to break it down and then see what they are doing. Is it to pursue that mission, to make sure that their products are achieving what they said to achieve, and then as an investor, then you see what is the probability that will bring money in. I think that's the only thing we can do, because even if you would just, even if someone were to say that, or if you agree that the Tesla is valuation is due to the manufacturing capability, you need to also know why the other companies are not doing the same, or why are the other companies are better in other things, right? So it takes a bit of technical ability to evaluate these kind of things. What we know is also very surface level, and what we see, actually Tesla is already one of the most transparent. If you're saying that BMW cannot make cars, is also fake, because if you go to their factories, they are also making cars every day, 1,000 pieces, 2,000 pieces. Is everyone can do it, right? But they might not be transparent in showing how they are doing it. So you need to have a certain level of understanding to go into that deep into the technology. So of course, not everyone can have that technical understanding, but what is good in Tesla is that there are so many YouTube videos that people break it down, make it easy for you to understand. So you try to evaluate in that sense. Okay, so there's also a lot of things that Tesla is not that good one. You can see that their quality, people say, or got gaps or everything, but you see them improving. Also, that's the thing, right? And I think if you say that EV got nothing tech, I don't understand that one. But if what you mean is that maybe what does it mean? EV got nothing tech, Kunti?
Yeah, I think that's one we can definitely tie it back to the upcoming questions. But I definitely agree with you that I think we sometimes tend to stay at the surface. Of course, you will start there, and then of course have to break down in order to understand the details now. And for those who are watching, right, if you want to more listen to more breakdown on this, right, yeah, I would suggest you watch the interview that I did with Kelvin. I think just a couple of weeks back, right, we talked about the investor day, all the sharings given by Tesla people, insiders, the management, talking about how they solve their problems and what's their manufacturing capability and so on. So there's a lot to break down already. I think that's very heavy materials in there. Thanks, Kelvin, to help us understand a bit more on that. So I'll put the link in the description so that for those who are watching this, you can listen to that interview. Then I think we can jump to the next question. I also want to hear your thoughts on this. Why do Xiaomi and Google have some EV business when they don't have auto business? Is it that they're doing software to install into cars like Microsoft and Dell relationship. Actually, I did some Google search on this and try to understand, right? And I think the general discussion on this is that actually now cars is not like, you know, cars 20 years ago, whereby cars is just like a machine running, right? Now there's a lot more electronics in the cars, and sometimes you will see cars not like just a machines. It's more like the electronic devices, and we can definitely see that in Tesla cars, because they are incorporating a lot of all this into their hardwares, right? So I think that's one reason, because they want people to you know, like the integrations part. I think that's the part that they want to build. And also car is especially EV is the growth areas, growth markets. That's why they want to get into it. I think these are the two explanations here. So come back to you, Kelvin. You have any comments with this or not?
Yeah, what I think is Xiaomi and Google is going into the EV business is because they want to take up more of your time, because when you are driving a car, you are not consuming their products that much. So I think that's why they feel that it's time to use that time and to eat up your time while you are driving also. I think if in the future, if they feel that even during your driving time also they already use up your time, the next step they might even go into your sleep already. They might even want to give you advertising during your sleep. So, but that's just in the future. But anyway, why do they want to go to the EVPs? I think that's basically just getting more eyeballs onto their product. They're trying to eat up more of your time. And then recently cars have become very I would say sort of commoditized already, because the way that the previous legacy auto manufacturers has been helping the supply chain, the suppliers are actually very, very advanced one. If you actually go to the a legacy car automaker, right? Most of the things the legacy car automakers, they don't know how to do really. It's always just paying for a supplier like Bosch, Continental, the biggest ones, and Delphi, you know, Denso, all these, even airbags, nobody is going to do it anymore, because it's all like you pick things from the shelf, and then you build into a car, you design a nice thing, and then you market it and sell it as like a special product. But if you go deep down, right, it's more or less everything the same one. You can actually buy it. So that's why I think Xiaomi, Google, they see that there's the supply chain is so mature already. They can leverage on using that. No need to build from scratch anymore, and then use their software to give a more compelling differentiation to their product, and then they want to eat into that new product space, because all the while in the car we don't really consume a lot of content. We are just listening or listening radio only, and radio or streaming is not Google and Xiaomi's main. I mean, streaming music, right? It's not. They don't have that content. So Google need YouTube, you know, and then Xiaomi has their own electronic products or what. They want to go into this new product range, and now the barrier of entry is even lower, because you don't the electric motor, the main important thing is already considered more simple than a combustion engine. Okay, because previously combustion engine is the one of the most complicated part in your car, one of the most important also. And you can see also from legacy automaker, all their engines is actually designed by them. There's no supplier. The supplier only supply the plugs, but they have to design themselves. So Xiaomi and Google nowadays, they can just say, okay, I want to just buy the whole motor. I don't care inside of what, right? I just can buy the whole thing. So in the sense that the barriers of entry is already very, very, very low. So they feel that it's time to use use your time, you know, to get your driving time 1 hour per day or what, to use more of their things, their software. And then is it they doing the software to install in the cars? I think yes, more or less. Google is also doing that, Apple is doing that. So they want to integrate their thing inside, so that they can also integrate your home, your smart home. So when your car come back, before the car come back, you know, your aircon is on, your rice cooker is cooked, and things like that. I think that's what they do.
Yeah. I think what they try to do is they want to evolve instead of just the operating system of your PC, which is Microsoft time, to now the operating system of your phone, which is iOS and Android. And the next one will be the operating system of your life. So you basically, they own you. You are like 24 hours onto their platforms, right? I think that they want to do. Actually, the one that is most successful in terms of in this is actually Tencent WeChat. WeChat is like everything, right? Including like paying utility bills, everything is on their platforms, right? I think that they are quite good on that. Come back to EV, I think yes, definitely still depends on how you look at it, because I believe there are still many people believe that EV is just a car. And let's say talking about Tesla is a car company. Many people have this view. At the same time, also there are people trying, or not trying, it's already starting to believing that EV is not just a car. There's two components. One is the hardware part, and the other one is the software part. And the software part is always the part that is like higher profit margin, and they want to get into this. And this will include the autonomous driving and all sorts of other, there's nothing to do with autonomous driving, like the infotainment, all these things. Still very new in this area. There's a lot of things to build there. So I think definitely this is why all these companies want to get a piece of it.
But
Okay.
we still don't know which business model may work. So we have to still go to, because Tesla is only in the car part and maybe the power in your house, but they are not in the smart home devices. They don't have a phone. So what Google, Xiaomi has is that they have already in your phone, in your life. Your whole life is on their platform, but they have not gone into your driving life yet. So see which business model work.
Yep, definitely. Still new. I think still a lot of experimentations. Okay, next one. All the other big owners, boss like Jeff Bezos, Larry Page, Gates, Reedings, Zuckerberg, etc., do they take big salaries like Musk? I think, okay, need to go one by one. I can't recall all of them, but I think generally when you say like Elon Musk take a big salaries, need to understand what they take is not like a salaries. It's basically the stock options. So in terms of stock options, right? Actually, you look at how much Elon Musk has profited from just Tesla alone, and you compare that against like you pull out like let's say the 10K of Tesla for in the past 10 years. You go and total up all the total expenses, right? It could be less than Elon Musk's net worth at the current moment. It's because the stock options, in terms of how much cost is recorded, right, it's actually recorded in when the options is given, meaning that they paid the price of the options, but subsequently, he is able to get like hundreds billions out of there. It's because the price has went up, right? So, and this is not in the total expense of the company. It will be in the form of dilutions, essentially, meaning that now you already give a share, all these like huge chunk of shares to Elon Musk, and then after that the share price appreciate, right? Hence he become rich, but not so much about like, okay, they from the company they pay out like hundreds of billions to Elon Musk, right? So you need to how to say, you need to understand this. There's a huge distinction, because if let's say Tesla just pay like hundreds of billions to Elon Musk, right, I think even Tesla they can't afford to pay this kind of salary to Elon Musk. But if they pay, let's say for example, like they paid Elon Musk just 10 billion, and suddenly next year, but the 10 billion is not in dollar but in shares account, right? But let's say next year the share price just 10x, suddenly this 10 billion become 100 billions. So how should we frame it? Should we say that Tesla already paid 10 billion or 100 billions? So you need to differentiate between these two. And I think for other, for example, like Jeff Bezos, Larry Page, most of them actually got rich because of their stake in the company. Okay, so they basically they own the piece of the company, and once this company become like so big, right? So they become rich now. So I think there's some similarity in terms of getting rich by having exposure have a stake in the companies. I think that's true for Elon Musk. That's true for Jeff Bezos. But if you want to say, okay, Elon Musk, in terms of the package, right, the package that he received from Tesla is definitely larger compared to the others that is listed here. So Elon Musk packages is very, very, how to say, lucrative for him. But you also need to understand is that when the package was given, the goal, right, that was set, right, for Elon Musk, that means he need to hit those milestones in order to get the shares, right? It's also like way larger as compared to the other stock packages that other has received. So also take note on that. In fact, when it was received, I mean the packages, the most recent one, right? I look at that, right, I was like, oh, no way, man. He can't, it's like I don't think he's able to achieve that, when I look at that. But actually he hit those milestones. That's why he get the pay. So I think this one, look at the details. I would say pull out I think I've discussed it in the past also, but you can look at the packages in the past and see. You have to go back to that point when it was announced and see whether you think that he's able to meet those milestones or not. I actually have a lot of skeptical. I don't think he's able to meet those milestones when it was announced. But surprise, surprise, Tesla always, exceed your expectations. So as a shareholders, let's say if I'm shareholders, I am happy to pay Elon Musk this kind of level as long as he's able to make those milestones. The milestone is not just share price, it's the share price plus I think the revenue and some operating figures. So definitely, yeah. He's able to meet that milestone. So. Anything to add, Kelvin or anyone else? Okay, no, let's move forward. Is WhatsApp being monetized in US? This one actually I pull up something. I think the answer to that question is yes. There's some monetizations. I think like WhatsApp, they have some what they call the WhatsApp Business Platform Cloud API and some on-premises API as well. So this is to help like small, medium enterprise to communicate with the customer. Say, for example, like you provide your numbers, and for example, I think even if you order things, right, you can actually WhatsApp. I think this is really helping all these small, medium enterprise business to use WhatsApp as a platform for communication. But that's the things, right? It is monetizable. It's being monetized, but it's very, very small. In fact, it's negligible if you compare to the business model of Meta. If you look at IG or Facebook, right, still it is like almost 100% is like ad business. Not so much about like all this API, how much you can profit from this, right? It's very, very small. But still, I think for Meta, they use WhatsApp not so much about like monetize it. It's more about like getting data, pull up data from WhatsApp and help them with the advertising. So how much value they can create from this is, I don't know. It's hard to come up with figures also, right? Secondly, they bought WhatsApp also just to kill off the competitions, right? And this is not, I think this is quite public. They actually explained this in the past. Because if they didn't buy WhatsApp, and WhatsApp, once they keep evolving and evolving, it can become some business that actually threaten Facebook and Instagram business. So instead of like trying to like compete, they just bought it over and kill off the competitions, right? So this is very how to say it's like a monopoly, right? So but still, yeah, it was approved. So I think it's good for Facebook. But I don't know. This is the things, right? You shouldn't look at WhatsApp as something that they can how to say, monetization is not their number one goal. But if they are able to monetize them in the future, definitely good. But in terms of traction, I don't see much traction in this segment as for now. So that's my comment on this.
Forward-looking statement is that generative AI is coming to WhatsApp, especially for businesses that manage a lot of their customers on the WhatsApp. They can easily search the conversations with their customers and figure out things like that.
Yep. Thanks. I think definitely they can help a lot with that, right? And there's already, API that can help out. So just need to wait, let's say, couple months, maybe 1 year later, we can see that it's totally different. All this, when we can chat with bot, like a human, I think they can help. Just with the customer service, I think it's already very helpful. Okay, next one. Where do we go to find economic activities, sentiments, consumers in China? because Weibo seems like not easy to use, not user-friendly. Any expert here? Want to, or anyone has any good resources for Chinese related data that you want to share here? No? Actually, I don't have that. I think even if you don't talk about like Chinese source, right? You just look at, let's say, trading economics, you can still able to find those like top line information, like all the PMI, China PMI data. I think they are some data that you can look at already if without going into the Chinese sources. So I think that should be number one source. Let's say if you can't navigate into the Chinese sources, right? So that one you can go to. Then in terms of the Chinese sources, I think definitely if you want to read more details, you want to read some commentaries, you want to understand more, definitely you have to go to those Chinese sources. It's just that I'm not a good person to ask. I'm not expert on this area. So I will stop commenting since I don't know much about this.
Wait for Baidu to come out with their own generative AI, then you just ask their generative AI.
Yeah, good idea. Which I think they came up with something already, it's just that it's not widely available, right? Yeah, I think let's wait for Ernie and see what we can pull out from there.
I think people say that the quality now not good.
Okay, I don't want to comment since I haven't used that before. I can comment on ChatGPT. Okay, next one. Zoltan Pozsar. Okay, I don't know how to pronounce. Suggested a 2040-2020 portfolio. Cash, stocks, bonds, commodities. Due to the macro wars and de-dollarization shift. You have any views on this? Okay, YCX, you should comment on this.
See who is he answering to? Who's he advising to? That's the big question. So
Let's say retail.
I mean, is his suggestion for retail? If it's for
No,
retail,
let's say we assume this is a suggestion for retail, right? What do you have any view?
like it's quite hard to get into commodities, because there's so many different commodities, and some of the ETFs, the expense ratio is quite bad, and usually commodities, the expense ratio is much higher. So there's one, and then other thing is that if you go into this kind of portfolio, you have to consider what's his duration. Is he suggesting this portfolio for how long? For
Long
2
term,
years, 3 years?
20 year.
If it's for 20 years, then you just put inside like that, and then let's say by the 5th year you see that the returns are not as good as something else, then what do? Is it the next time he suggests something else, then you follow as well? Then is that what it is? Is that what it is, then should just have some kind of ETF that follows Zoltan Pozsar suggestions, and you just buy that ETF. Better follow him directly instead of what he suggests. Because his suggestion is, I mean, is workable, but the thing is that you don't know when is the entry, when is the exit, and then you also don't know who exactly is he suggesting for that can maintain this kind of portfolio. Because a lot of the times, like your retail, you might not have the kind of like investor mindset as whoever he's suggesting towards. Sometimes these people whom he suggests towards already have some kind of income stream, and this is just a all-weather portfolio to ensure that their wealth is not lost over time. Yeah, then it may not be a wealth building portfolio. It could be a wealth preserving portfolio. So there's a lot of things to consider when someone suggests this kind of portfolio. Like, you know.
Yeah, totally agree. I think my comment on this is I don't know who is Zoltan Pozsar. I can't even pronounce his name. So I don't know, but this type of allocations, right, when you look at like what 2040, 2020, and then it is like different asset class, right? This is not even like, sector. This is asset class, like cash, bonds, stocks, commodities. This is usually what we call the all-weather portfolio. I think the intention is really not to say that, okay, if you have this kind of allocation, then you can outperform. Because if you look at this, right, by definition, you can't outperform, because this is like a very, how to say, a very like kind of like very flat or equal allocations to the main asset class. So if you have equal, meaning that you just go passive, like either way, there's some specific period where stock outperform, some period commodities outperform, some period cash outperform, and so on. When you have this kind of like equal allocations to different asset class, what happens is that you just average out across period. It's supposed to be like for wealth preservation instead of like having a good returns lah. So I think if you look at Ray Dalio's all-weather portfolio, I think it's something looks very similar to this also. I think it's more like 40% fixed income, maybe some 30% into equity and the rest in others lah. So if you are looking for wealth preservation, I do think that this is a good start. It's very generic, I would say, so nothing really to criticize here. But I think as let's say put this in the context of like a retail investor, right? Say, for example, you already buy your own house, you already have your commodities. I would say commodities here include like precious metals, real estates. What else? Let's say if you want to count like all those oil futures and so on, ETF, you can put this under commodities as well. But since you have some hard assets, right, like real estates, I will put them into this category. So you don't have to worry so much about commodities already. It's just that when it comes to cash, stocks, bonds, this one really depends on like how many years you are able to compound. Say if you are still young, put more into stocks. And if you are closer to retirement, put more into cash and bonds. I mean, this is a very generic kind of allocation and it works for preservations now. So I won't say I want to criticize or anything on this. It's just more like just to understand the context is that this is just a all-weather portfolio. You can do the all-weather portfolio Google search and read about Ray Dalio and understand what's the thinking process behind that when he forms the all-weather portfolios. You get the idea. I think the idea is more important than the specific why 2040, 2020 here. Okay, thanks for the questions. The last two questions. Are you afraid of the inventory built out in some of the semiconductor companies, for example, NVIDIA and TSMC? Okay, everything about NVIDIA, YCX is the person to comment. YCX?
I mean, definitely, the coming up, there's, of course, we look at AMD first, then after that, there's a few other companies before the NVIDIA earnings. So can kind of see from there what exactly their earnings are like, then make a decision on that. So for me, because I am heavy NVIDIA and I can afford to actually like just closer to maybe 2 weeks before the actual earnings itself, I get into like some put positions and balance out in that way if I want to. So that's how I usually look at earnings and look at all these forecasts and numbers, because they don't all report earnings on the same time. So they report earnings over a month, so you can see which ones come in first and which one come in later. And then not only that, there is also usually because this kind of like industry, they all move in tandem one. So you can kind of see HP results, you can see Dell results, you can see AMD results, Micron results, TSMC results before you see some other results. And then if I see inventory buildups in all these, then I also kind of, I think inventory buildup is kind of coming. Then I will take some hedges to balance out the risk, because I am in such a heavy NVIDIA position, so it is in my interest to look for that.
Thanks for the comment. You covered NVIDIA. I will cover a bit on TSMC. But actually, just for context, right? Both YCX and myself, we invest like YCX is NVIDIA. I also have NVIDIA. I have TSMC. We tend to look at this more like a long-term investment rather than talking about like understanding the cyclicality and try to trade around the cyclicality. I know YCX you have some options to trade around the cyclicality, but for myself, I don't do much on that. So when you ask about like, are you afraid of an inventory build out? I think it's the same thing as asking like, are you afraid of the cyclicality of the semiconductors? My answer is no. The reason is because if you're afraid, right, actually you would have sold off your investment like let's say maybe 2 months, 2 quarters ago, because actually right now we are in close to the, around the down cycle of the semiconductor. You look at Nvidia, it has been like, the drop in terms of their sales already 2 to 3 quarters. And for TSMC also same. They said the worst quarter is the current quarter, right? Either Q1 or Q2 this year. And subsequently, they are expecting the recovery of the semiconductor sector. So if you can ride through the, the down cycle, the bottom cycle, then it shouldn't be a concern when they are riding up, right? So for me, it's just like I don't care about the cyclicality, meaning if they are down, then we just endure. Once it recover, then you can see that their result will be improving, and we get like much better cash flow and returns. It's just that for TSMC, still need to worry about the capex lah. So they still have to spend a lot of capex building up their 3nm, 2nm fabs. That one is definitely something to watch out for. But in terms of the cyclicality of the sectors, I think this is like, if you are not happy or not comfortable with that, I think just stay away from the semicon industry lah. But if you are okay with that, then you see we are in that now. Like, are we afraid? I don't think so. I think it's just like you just need to understand. Once you understand this thing is cyclical, and once the down cycle comes, right, we are at least psychologically prepared. You are prepared to look at the results getting worse and worse, and doesn't mean you should sell. Because the moment you sell because of all this cyclicality, that means you are trading around the cycles. Yes, maybe you can, time the market better than the other, right? And you can get some good returns. But my sense is that it isn't that easy also. Like you need to know, like get the insights or get the information faster than others in order to generate some alpha around it, right? Not so easy, I would say. For me, it's really just for long-term investment.
Yeah, so actually the thing over here is also that because that's why I'm also kind of like I don't actually like sell my holdings kind of thing. I just play around like some options, right? Because for me, I'm a bit more familiar with options in terms of like how I can use a minimal amount of money to hedge against my own positions. Yeah, so that is why I do options for some of these, and some of the times I do options. It's not like I will hold the options all the way to the end, and it's like I just see that around like the news, right? Like I'm just trying to hold through a certain news event that I think might be might have an increase in volatility, that kind of things. And sometimes it's kind of like, for example, I might just buy like 3 weeks before, I might just buy like let's say Nvidia is at 250, I might just buy a 250 put, and then if let's say it goes down or whatever, or the IV just goes up, right, I could just sell like a 245 put or 240 put for exactly the same price. So I'm actually not having any losses or anything like that. It's just like a hedge kind of thing. And while I'm doing that, of course, for me, because if I do that, it gives me a bit more confidence to actually increase like my DCA in it lah, because DCA is supposed to be every month kind of thing. And then sometimes like my positions in Nvidia get so large, is very hard to think about it lah, in terms of that lah. So there is always this because I'm quite heavy in it due to the direction of what I think will go on, because I base my investments on like the direction of where I think things will go like 2-3 years down the road in the future. And that is why I invest in this way. My investment is considered quite high risk and volatile, which is why I have so huge percentage in Nvidia. That's why I play these kind of ways. So kind of like it depends on what is the kind of outlook that you have, and if you are not that bought into like the certain vision of like a company or whatever, you might not invest in the same way. It's just like I know people who buy a lot of Tesla, or like some of them like maybe have like 80-90% in Tesla, that kind of things one. And because I don't really buy into the vision of Tesla that way, I don't even have any Tesla at all. So that's, to me, it's just that, that kind of idea lah. So it's how you look at things, and the most important thing in terms of like long-term investing is not about inventory build up here and there or this kind of thing. These are like year to year kind of things. You might have a bad year, you might have a good year, that kind of things. But most importantly is you kind of look at what is the direction of the company going, what exactly are they doing, and are they well positioned to capitalize on like what is happening 2-3 years down the road? Because like these companies are like very slow moving ships. They're quite big and they take a while to pivot on. So you can kind of see that if they take a while to pivot, you see over time, is it they are already losing out or they are still gaining or that kind of things, right? And you can kind of see, is it time for you to also pivot out or continue on? Yeah, that's what it means for long-term investing, or you get the direction correct is more important than the day-to-day volatility. Day-to-day volatility is only if you cannot take the loss, or you cannot really look at it, and then you kind of like think you really need the number to be going up all the time. Then in that case, you probably should go into bonds or something. Yeah.
Yeah, definitely. Don't know how those looking at daily volatility and want to, have some smooth return at the same time want to have high returns, right? I really don't know how. Doesn't align well. Okay, I think last question already, and time for lunch. Have anyone heard of Dogs of STI based on Dogs of Dow, which in theory generate good dividend returns? Have anyone done an intensive back testing on it? Okay, for me, I haven't heard of Dogs of STI. I have heard of Dogs of Dow, but I haven't really like done any research on this area. I think this is like what is mentioned here is like, okay, I think a lot of focus when it comes to the dividends. I think they only choose those with high dividends and large company and good dividend companies. Essentially is a proxy for like dividend ETF. I think should be quite similar. I don't expect them to be that different. But again, I haven't looked into very details. Y6, you know anything about this and want to comment?
I did a bit of research on dividends. Usually, what I do like is the NOBL, which is Dividend Aristocrats, because they have the criteria for being a dividend aristocrat is very strict. So I think only like 50 plus or 60 companies qualify for it, and it's usually companies that have like increasing dividends year over year without fail, that kind of things. So you can kind of see that they are like cash flow rich companies. So if you're looking at dividends, is to me, when I look at dividends, I don't just look at this company. I just look for the highest dividends, 9%, 10%. Sometimes you see those companies, they give 10% dividend, but then you see their stock drop like crazy over time. Kind of things is, you also think it's like you are picking up a penny in front of the steamroller like that. It doesn't make much sense. Or if your dividend is high, but then your value the cash flow is varied or funny or something. So when I look at this, I'm not sure about Dogs or STI or Dogs or Dow, but if they are anything similar to dividend aristocrats, then okay lah, it's a good choice. If that is your kind of profile, why not? It's okay if you want to put into that, and it has a Singapore flavor to it. Yeah.
Singapore flavor. I think Singapore one, let's say if you don't get into the dividend specific one, just invest in STI itself is already like quite a dividend friendly exposure, because the larger names are all like like DBS, OCBC, UOB, like, and all of them are paying dividends. So I think if you don't want to be too fancy and do like so-called all this like Dog of STI, just do STI. I think it shouldn't be that different. That's my sense now. And you keep it simple. It's just that whenever you invest in STI, you need to aware that this is like concentrated bet on Singapore. It could turn out well, or it could turn out like not as well, depending on how Singapore business is doing. So I think just be aware of that now.
Yeah, because you're already earning, let's say you are working in Singapore, you're already earning income in Singapore, then you already put money into CPF, and then you still buy Singapore stocks, then it's like you're all in Singapore. If Singapore does well, well, you're very good. There's nothing to say about that. It's a legit all in Singapore strategy. It's workable.
Yeah.
Sometimes like there's also disadvantage, which is all this tech. You can kind of see in Singapore's own philosophy is that Singapore right now is quite risk averse. They don't want to be like the front runners in a lot of things. They want to see that there's like some kind of working approach, and then they will once there's a working prototype or something, then Singapore government will like go into it. They want to be like the second runner. Once they see some result, then they put in. So that is the Singapore direction kind of way. Then you can kind of see that there are other places where they just go all in like new tech or things like US is probably considered one area in that they just go all in something. Then it's how you want to look at it and what is your appetite in this. The other thing I would say is that using Singapore as a proxy for China could be quite profitable as well, because China kind of like going forward, if the deglobalization is going apart like that, China has quite limited options in terms of where they want to set up companies that is both friendly to the west and to the east side of things, and Singapore is a top destination. So it is kind of like a semi-Chinese play if you want to go into Singapore stock market. Yeah.
Yep. Okay. Thanks a lot for the comment. And I think we should stop here. More than 2 hours this round. Thank you so much for joining. For those who are listening, hope you enjoy the content. All right. Thanks, YCX. Okay. See you. Bye bye.